If you have any money at all in any investment, you better know this chart. This is the historical price to earnings ratio of the S&P 500. It starts in the 19th century and it shows us that if you buy into the stock market today, you will get your money back in terms of earnings over the next 40 years. That's your break-even point. It's extremely expensive to own stocks now. Now, there's a saying that time in the market beats timing the market. In other words, it's very hard to pick the top in the stock market, or any market for that matter, to then try to buy back in lower again. But the problem is there's so much correlation within the asset markets. We have seen this in the year 2000, right, when the dot-com bubble crashed. It wasn't just technology stocks that sold off. It was also regular stocks, regular S&P 500 stocks that went down. We've also seen this in 2009 during the global financial crisis, right? It was the property market that delevered, a lot of forced foreclosures in the US property market, yet globally we saw all asset prices going down, including the stock market. In other words, there is a contagion effect here. If technology stocks and the speculation on AI is currently overblown and we see valuations coming back down, this will have an impact not just on the Nasdaq 100, not just on the S&P 500, it's more likely than not also affect crypto. Now, there are many different ways to try to value asset prices. We can compare them with future earnings, but we can also have a look at the value of an asset class relative to the monetary base, relative to how many dollars are currently floating. And the most common such value is USM2, the M2 money supply in the US. This is the S&P 500. This chart starts in 1959. This here is .com. And again, it was not just technology stocks that went down. The S&P 500 also lost versus the monetary base by more than 50%. And then here is the global financial crisis. Again, a drop of more than 50% in the stock market. It was not just the property market that was suffering. Over here, by the way, that is when Bitcoin was born. The average ratio of the S&P 500 stock market valuation relative to the money supply is indicated as this white line over here. So if we think that there will be a long-term equilibrium, that this valuation is actually moving below and above something that could be regarded as a fair valuation, then currently the prices that we face in the stock market, we are overvalued by 95%. In other words, a 50% drop in the Shiller PE ratio is definitely reasonable. It's very much possible that we go back down to 20 again. Now, there are many different measures for liquidity. We can use USM2, so that's this chart over here, but there's also the TCMDO. This is something that's less commonly used. It's the debt that's outstanding across all sectors. It shows how much leverage there is in the system. The main difference is that M2 does not include corporate bonds. It does not include treasury debt by foreign entities. But both of those are very likely going to increase valuations, because they do increase liquidity. The M2 money supply tends to grow by roughly 6.8%. So this is how much the monetary base is devaluing. I know that the official inflation rates only tend to be at around 3% per annum, but that's just consumer prices. And consumer goods tend to become cheaper over time, right? It gets easier and easier to produce that TV or to produce that mobile phone. We've got technological progress, we've got increases in productivity. Thus, we should expect that those things become cheaper. But because our monetary base is expanding by 6.8% per annum, we do see inflation. Not by 6.8%, but by 3.1% roughly. But that is USM2. By the way, in the last 66 years, that growth rate adds up, right? The monetary base increased by 77x during that time frame. Here is TCMDO though. So this measures the debt. Now have a look at this. This is TCMDO relative to USM2. Leverage grew faster than the money supply. Over the last 65 years, that's an additional growth of 90%. If we annualize this, we've got roughly 1 more percentage point per annum in growth on top of USM2. So really, we're not looking at a monetary base expansion of 6.8%. We are looking at an expansion of 7.8%. That's the hurdle rate. If you do not make 7.8% with your investments year over year, long term, you are falling behind, relatively speaking. You do not need that kind of growth rate if you're just interested in consumer goods, but you do need that growth rate if you're interested in something rare, right? Into something that can't get inflated away. Something like land, for example. Now let's have a look at this turnaround point, when suddenly the leverage tended to go down in the system. What we see over here, that's the S&P 500 relative to TCMDO. And what we see over here, that's the S&P 500 relative to USM2. The leverage stopped increasing just before the global financial crisis. And it never picked up since then. Asset prices did go up because the base money expanded, or the Fed balance sheet went up, USM2 increased, but the leverage, the risk taking, that did not go up on average. It's actually quite interesting because this chart, right, the S&P 500 relative to USM2 implies that there's really not that much more growth left. That maybe after an additional outperformance of 7% or so, we might come crashing down again. We might see another .com bubble burst with potentially even another bubble popping a few years later. But the S&P 500 relative to debt, relative to TCMDO, that still has a bit more upside. It's 28%, it's not great, but it does show us how it's very hard to time the exact top of those things. Yes, again, valuations aren't pretty based on PE ratios, but that's just one of many potential ways to value the stock market. What I think is most important in all of this is to try to not be over-allocated towards the asset classes that tend to be expensive. We can't necessarily time the market top in anything, but we don't have to be over-allocated towards that asset class, right? So as we reach higher and higher valuations, we can just take profit, we can just sell off, and then reallocate this towards something that's comparatively cheap. Now, a few years ago, this tended to simply be gold, but gold has already rallied quite a bit now. Seems like now the risk-off asset might be long-term government bonds. It's a very contrarian view, but most people don't want to buy long-term government bonds. And maybe the US is going to prop up that market. And maybe if the market overall gets fearful again and wants to get rid of AI exposure, they might go towards a safe haven asset again. And if gold is already very expensive, what's the next safe haven asset? It's probably not property. Property yields are very, very low. It's rather long-term government bonds. They give quite good yields right now. Again, the issue is correlation. This is S&P 500 relative to TCMDO. And what we see at the bottom, that's the Bitcoin price. Both bottomed at the same time during COVID. Both peaked at the beginning of 2022. They then bottomed at the same time. They're now going up at the same time. And really, the problem is that long-term correlation. The issue is that we really have never seen a real crisis in Bitcoin. What happens if suddenly the stock market crashes versus leverage by 77% or potentially even by 80%? Will Bitcoin, quote unquote, only drop by 80% if the stock market underperforms the debt issuance to that degree? I doubt it, right? The problem is the biggest, quote unquote, crisis we have seen so far was just COVID. And COVID really wasn't that much of a deal for the stock market. A drop of 25%, while Bitcoin during the same time frame lost 50%. So if the stock market was to fall by 80% relative to that, then who is saying that Bitcoin can't fall by 90 or maybe even 95%? Imagine that, right? Bitcoin suddenly going down to 12 or maybe even to 6K. That's something nobody has on their radar, but there's a potential outcome in case we get through a real depression. Now, I'm not pretending that I know what's going to happen. I'm simply just looking at the data and I see high valuations. And that, in return, tells me it makes sense to be a bit cautious. I don't think it's essential to squeeze out the last little bit of risk on performance. I think it's rather essential to preserve capital and have enough to potentially buy low in case we do see a crash. It's just a game of risk versus reward. And how much reward is there really when the price to earnings ratio is historically already that high? Do we really expect that PE ratios are going to go to 100 or to 200? Or do we expect that earnings will again double, triple and quadruple from here? Now, once Bitcoin is around 40 or 50K, then it can very easily double or triple from here. But right now, if it was to double at say 100K, it would go to 200K and to 300K. Then it would get closer and closer to the gold market cap. And how realistic is it really that Bitcoin is going to flip gold in the foreseeable future? I don't think that's the most likely scenario. And so if you want to know how I personally set myself up in this environment, then feel free to check out the premium membership. I publish market updates every 3 to 4 days, and I share every single trade that I'm doing over there as well. Due to diversification, I don't have too much volatility in my net worth. This here is a monthly chart. And in January of 2026, I will open a new copy trading vault for the crypto part of your portfolio. So if you're interested in simply just automatically copy trading whatever I trade, then premium might be for you, right? This is how Bitcoin developed in the last few months. And this is how the copy trading community pool developed during the same time period. We opened that project in July of this year, and deposits will reopen again in January. So don't miss that. If it's your first time here, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. See you next time on YouTube or see you on Premium. Cheers.